The most dangerous belief about supplemental security income is that the government automatically pays every old 5-4. That belief can quietly cost a person hundreds of dollars every month. In 2026, the maximum federal SSI payment is $994 for one eligible person and $1,490 for an eligible couple, but those numbers are not a promise, they are not a universal retirement bonus, and they are not placed into every eligible bank account automatically. One person can receive $994, another can receive $662.67, another can receive only a small supplement, and another can receive nothing even though all four people are the same age and live on very limited income. The difference can come from one line in a housing arrangement, $20 of income that was counted the wrong way, a bank balance on the first day of the month, a spouse's paycheck, a state supplement that was never requested, or an old record that no longer reflects how the person actually lives. Pay close attention to this, because the higher payment is not simply about waiting for Social Security to raise the check. You have to understand what Social Security is counting, what it is allowed to ignore, and what you must report or claim before the system can calculate the right amount. Stay with me through the end, because I am going to show you the protection step that most people never learn until after they have already lost months of money. The first thing I need to make clear is that SSI is not the same as Social Security retirement. Social Security retirement is generally based on your work record and the Social Security taxes paid during your working years. SSI is a needs-based program for people who are age 65 or older, blind or living with a qualifying disability, and who also have limited income and limited resources. A person can receive Social Security retirement and still qualify for some SSI. A person can receive SSI without having enough work credits for a retirement benefit. A married couple can have one spouse receiving Social Security and the other receiving SSI. A widow can receive a small survivor benefit and still qualify for an SSI payment that brings her closer to the federal level. Most people think they do not qualify because they hear the word Social Security and assume every program follows the same rules. It does not. Here is what almost nobody understands. The system does not look only at your age or your monthly check. It looks at where your money comes from, how much of that money legally counts, what you own at the beginning of the month, who lives with you, who pays the shelter bills, whether you are married, and whether your state adds money on top of the federal payment. The official 2026 cost of living adjustment increased SSI by 2.8%. The federal maximum moved from $967 in 2025 to $994 in 2026 for one eligible person. The eligible couple maximum moved from $1,450 to $1,491. Nearly 7.5 million people receiving SSI were affected by the increase, and the first increased SSI payment was issued on December 31, 2025, because January 1st was a federal holiday. That early date confused many people. Some thought the deposit was a special extra payment. It was not. It was the January payment arriving one day early. This matters because payment timing and payment amount are two different things. A calendar can cause two deposits to appear in one month and no deposit to appear in the next calendar month, even though the person did not receive an extra benefit and did not lose a benefit. This is happening quietly every year when the first day of a month falls on a weekend or federal holiday. The money is usually due on the 1st, so Social Security sends it on the last business day before the 1st. If you judge your eligibility or your monthly budget only by the date the deposit appears, you can make the wrong decision about what money belongs to which month. Now watch how this works. Imagine a 71-year-old woman named Linda. She receives $540 a month from Social Security based on a short work history. She rents a small apartment, lives alone, and has $800 in her checking account. She assumes SSI is only for people who receive no Social Security at all, so she never applies. But SSI does not necessarily count every dollar of her Social Security payment. In a simple federal calculation, the first $20 of most non-work income is generally not counted. That means $520 of Linda's $540 could be countable. The 2026 federal rate of $994 minus $520 leaves a possible federal SSI payment of $474 before considering state supplements and any other facts. Linda may not receive exactly that amount because real cases depend on every detail, but the example shows the mistake. A person can already receive Social Security and still qualify for SSI. This is not automatic. Nobody is going to tell you about this simply because your retirement check is small. Social Security does not open an SSI claim for every retiree and calculate every possibility without an application. You have to claim it. Now imagine a different man named Robert. He is 67, receives $1,020 in Social Security retirement, owns the home he lives in, has one vehicle, and keeps only $1,400 in the bank. He hears that the SSI maximum is $994 and assumes his $1,020 check makes him ineligible. In many situations, that assumption may be correct because his countable non-work income could be above the federal SSI level after the usual exclusion. But that does not mean the conversation ends there. His state may have a supplement with different payment categories. His spouse may have separate eligibility. He may qualify for help connected to Medicare prescription costs even if he does not qualify for federal SSI. And if his income later falls because a pension ends, a spouse dies, or a household arrangement changes, the answer can change. The point is not to promise Robert money. The point is to stop him from treating an old answer as permanent. SSI eligibility is a monthly calculation. A fact that disqualified you last year may not disqualify you now, and a fact that qualified you last year may reduce or stop the payment now. This is why the headline about a higher payment must be understood correctly. There is no honest way to say that every retiree will receive a new $994 payment. The real update is more important than that. The federal ceiling is higher in 2026. The calculations still contain exclusions that many people miss. Older living arrangement rules were simplified, some state supplements can raise the total, and the Social Security Administration is using more automated tools to check wages and financial accounts. That combination creates two opposite possibilities. Some people are receiving less than they may qualify for because they never reported a favorable change or never applied. Other people are receiving more than the rules allow because an income, resource, or household change was not reported, and that can create an overpayment notice months or years later. The safe path is not fear. The safe path is understanding the calculation before the system makes a correction for you. The next belief I want to break is that the number on your bank statement tells Social Security everything it needs to know. A bank statement shows money moving in and out. SSI rules ask a different question. They ask what counts as income in the month you receive it and what counts as a resource if you still own it at the beginning of the next month. That difference is where ordinary people get trapped. A $1,000 payment can be income when it arrives. If some of it remains in the account on the first day of the next month, the remaining money may also become a resource unless a specific exclusion applies. A federal tax refund, however, is not counted as a resource for 12 months after receipt under SSI rules. Retroactive Social Security or SSI benefits are generally excluded from resources for up to 9 months. A home you live in is generally excluded. One vehicle used for transportation is generally excluded regardless of value. Up to $1,500 in designated burial funds for each spouse may be excluded. The first $100,000 in a qualifying ABLE account can be excluded for SSI purposes. Most people never realize this. They hear the $2,000 resource limit for an individual and panic because their home is worth $180,000 or their car is worth $22,000. Those items may not count. At the same time, they may ignore a second savings account with $2,400 because they think a small bank account is harmless. That account may count. The resource limits remain painfully low in 2026. Countable resources are generally limited to $2,000 for one person and $3,000 for an eligible couple. Those numbers did not rise with the 2.8% cost of living adjustment. Think about the impact of this. The monthly federal payment increased, food prices increased, insurance costs increased, and interest rates affected what families paid on credit cards and loans, but the basic SSI resource limits stayed at $2,000 and $3,000. That means a retiree can be financially fragile and still have too much countable money for SSI. A person can keep enough cash to replace a broken refrigerator and suddenly be over the limit. A couple can save for a car repair, cross $3,000 at the wrong time, and lose eligibility for a month. This helps both lower-income retirees and comfortable middle-class retirees understand the same lesson. The rules do not measure financial comfort the way ordinary families do. They measure specific categories on specific dates. The Federal Reserve does not set your SSI payment. The annual cost of living adjustment is tied by law to a federal inflation measure, the Consumer Price Index for urban wage earners and clerical workers. But Federal Reserve decisions still affect the life around the payment. Higher interest rates can raise credit card costs, auto loan costs, and some housing costs. Lower rates can reduce savings account earnings. Inflation can increase groceries, utilities, insurance, and rent faster than a retiree feels the benefit increase. So a 2.8% increase does not mean a retiree is 2.8% better off. A person receiving the full federal individual amount gained $27 a month compared with the 2025 maximum, moving from $967 to $994. One increase in rent, one new prescription cost, or one insurance premium adjustment can consume that amount. This is why understanding whether the person is receiving the correct full amount matters. A missed $100 or $200 is not a small bookkeeping error when the entire monthly payment is under $1,000. There is another quiet distinction between SSI and regular Social Security that confuses taxes. SSI payments are not taxable federal income. Regular Social Security retirement, survivor, and disability benefits can be partly taxable, depending on filing status and other income. The IRS does not include SSI in the category of taxable Social Security benefits. That means a person who receives only SSI generally does not receive an SSA 1099 for SSI and does not report the SSI payment as taxable Social Security income. But do not stretch that rule too far. Interest, pension income, retirement account withdrawals, wages, and other money can affect taxes, SSI eligibility, or both in different ways. A Roth IRA withdrawal may be tax-free under federal tax rules if all conditions are met, yet money available in a retirement account can still be relevant under SSI resource rules. A 401k can be treated as a resource if the owner can withdraw a lump sum. An inheritance can be non-taxable to the recipient for federal income tax purposes in many cases, but the inherited cash or property can still affect SSI. IRS rules and SSI rules are not the same set of rules. One agency can say no income tax is due while another agency says the money affects eligibility. That is the first major revelation. The word tax-free does not mean invisible. The word excluded does not mean excluded forever. The word retirement does not mean the money is protected from every benefit calculation. And the words maximum payment do not mean automatic payment. Once you see those four distinctions, the system becomes less mysterious. But it also becomes more urgent because the next part is where a simple household favor can change a check by more than $300 a month. For years, one of the harshest parts of SSI involved what Social Security calls in-kind support and maintenance. I will say it in plain language. This is help from another person with basic living costs. Since September 30th, 2024, food that someone gives you or pays for directly is no longer included in this particular calculation. That was a meaningful change. Before that date, a daughter buying groceries for her mother could create questions about whether the mother was receiving support that reduced SSI. Under the newer rule, the value of food itself no longer reduces the SSI payment through the in-kind support and maintenance calculation. But shelter is different. If someone pays your rent, mortgage, electricity, gas, water, sewer, or certain other shelter costs, the help can still reduce SSI. This is where many families hear only half the update. They hear that family help no longer counts, but the rule did not erase shelter support. It removed food from that calculation. The 2026 numbers make the consequence easy to see. The maximum federal amount for one eligible person is $994. Under the presumed maximum value rule, shelter help can reduce the payment by as much as one-third of the federal rate, which is $331.33 in 2026 after the general exclusion is applied in the standard example. The person can fall from $994 to $662.67. That is a difference of $331.33 every month, or $3,975.96 over 12 months. Think about a 74-year-old mother living in her son's house. The son pays the mortgage, electricity, water, and gas. The mother uses her SSI for medicine, clothing, transportation, and personal needs. She believes she is receiving the lower amount because of her age, or because Social Security does not pay more in her state. The real reason may be the household arrangement. Now suppose the total household shelter expenses are $1,600 and 4 adults live there. Her fair share is $400. If she begins paying the full $400 share and reports the change with proof, the one-third reduction may no longer apply. She may move toward the full federal amount if no other countable income or reduction exists. This is not automatic. She has to report the new arrangement and Social Security has to evaluate it. The proof matters. Saying, "I help with bills" is not always enough. A simple written household agreement can make the facts clearer. It should reflect reality, not a story created after the fact. It can show who lives in the home, the monthly rent or mortgage, electricity, gas, water, sewer, and other shelter costs, the total amount, and the share the SSI recipient actually pays. Keep receipts, canceled checks, bank records, or signed statements showing the payments. Do not hand a family member cash with no record and assume the agency will understand later. When a review happens, the representative is not standing in your kitchen watching who pays what. The representative sees forms, statements, account records, and answers given during an interview. If the facts are unclear, the payment can be calculated in a way that surprises the family. There is also a nationwide rental subsidy rule that many people still do not understand. Beginning September 30th, 2024, Social Security expanded a rental subsidy exception that had previously been limited to 7 states. In certain family rental situations, paying a required amount of rent can prevent Social Security from treating the difference between that rent and market rent as countable shelter help. Social Security estimated when the rule took effect that it could increase monthly SSI payments by about $130 for roughly 41,000 people and allow more people to qualify. Notice the words could and about. This was not a guaranteed $132 payment for everyone. It depended on the relationship to the landlord, the required rent, the presumed maximum value, the current market rental value, and other facts. But for the person who qualifies, $130 a month is $1,584 a year. Nobody is going to tell you about this by looking at your rent receipt from across the room. You have to ask whether the rental subsidy rule was applied correctly. A similar change expanded the definition of a public assistance household. The newer rule can include households receiving SNAP and can apply even when not every person in the household receives public assistance. Why does that matter? Because the way Social Security classifies the household can affect whether support is counted and how much the SSI payment is reduced. The words on the form may sound administrative, but the result is groceries, rent money, and medicine. This changes everything for a small group of people because the payment can rise without any new law creating a universal bonus. The higher payment can come from correcting the category that Social Security uses to describe the household. Let me slow this down, because behind every calculation is a person who worked, raised children, paid bills, and believed that following the rules would create peace in old age. I have seen the fear that arrives with a white envelope from Social Security. The person reads the first sentence, sees the word overpayment or reduction, and feels as if the floor has moved. A widow who has never missed a bill starts wondering whether the government will take her entire check. A veteran who trusted direct deposit begins checking his bank account 3 times a day. A retired mechanic who spent 40 years repairing other people's cars cannot understand why a daughter paying one electric bill changed his benefit. A woman who moved in with her sister after a fall feels guilty because the household help that kept her safe may have reduced the money she needs for basic expenses. This fear is not foolish. The system is complicated, and notices are often written in language that does not feel human. But fear becomes dangerous when it causes silence. Some people ignore the notice. Some stop opening mail. Some move money between accounts without understanding the rule. Some give away money to get below the resource limit, not realizing that giving away or selling a resource for less than its value can create up to 36 months of SSI ineligibility. Some cancel a bank account but forget that the closing balance moved to another account. Some assume that if the agency made the payment must be correct. That is not always true. An incorrect payment can continue for months and later become an overpayment debt. If this information is helping you understand your own payment more clearly, leave a like on this video. It helps this explanation reach other retirees who may be losing money simply because nobody ever translated the rules for them. Now we need to talk about income, because income is not counted the way most people expect. Start with non-work income. This includes regular Social Security benefits, pensions, unemployment payments, some veterans benefits, interest, dividends, and cash from friends or relatives. SSI generally reduces the federal payment by about $1 for each dollar of countable non-work income after applicable exclusions. The most familiar exclusion is the first $20 of most income in a month. That small number has not kept pace with modern costs, but it still changes the calculation. Suppose a person receives $300 in Social Security. Subtract the $20 general exclusion, leaving $280 in countable income. Subtract $280 from the $994 federal rate, leaving a possible federal SSI payment of $714. If the person's state adds a supplement, the total can be higher. If the person receives shelter help, the total can be lower. The calculation is a stack of rules, not one simple income limit. Earned income follows a different path. SSI generally does not count the first $65 of monthly earnings, plus one-half of the earnings over $65. If the person has no non-work income using the $20 general exclusion, that $20 can also apply, making the first $85 of wages effectively excluded, before half of the rest is counted in the simple example. Suppose an older worker earns $317 in gross wages during a month and has no other income. Subtract $20, then subtract $65, leaving $232. Divide that by 2, and the countable earned income is $116. Subtract $116 from the $994 federal rate, and the federal SSI amount is $878 before any state supplement or other adjustment. The person earned $317s, but SSI did not fall by $317. It fell by $116 in this simplified example. Most people think they do not qualify if they work at all. That is wrong. Work can reduce SSI, but the system does not always count every dollar of wages. There are additional work rules for people with disabilities. Certain impairment-related work expenses can be deducted. A person who is blind may deduct certain work expenses under separate rules. A student under age 22 can have a much larger student earned income exclusion, which in 2026 can exclude up to $2,410 a month until the annual maximum of $9,730 is reached. A plan to achieve self-support can allow certain income or resources to be set aside for an approved work goal. These rules are not mainly for a typical 68-year-old retiree, but they matter in families where an adult child receives SSI or where a person reached retirement age after years on disability. The larger lesson is that gross income and countable income are not the same thing. Now consider a part-time worker named James. He is 66 and earns $600 a month helping at a hardware store. He has no pension and a very small Social Security benefit of $250. He looks at $850 coming in and assumes there is no SSI. A simplified calculation begins by applying the $20 general exclusion to the $250 Social Security benefit, leaving $230 countable non-work income. Then the earned income exclusion applies to wages. Subtract $65 from $600, leaving $535, and count half, or $267.50. The total countable income could be about $497.50. Subtract that from $994, and the possible federal SSI payment is about $496.50 before rounding, state rules, living arrangement, and other facts. James could have total monthly cash far above the SSI check alone because work is treated more favorably than non-work income. This is why a person should not reject himself before Social Security reviews the case. But there is a danger on the other side. If James reports $300 in wages when he actually earned $600, the payment may be too high. If the error continues for 10 months, the overpayment can grow quietly. The agency can later receive wage data, compare it with the reported amount, and issue a notice. In 2026, the Social Security Administration says it has fully implemented the Payroll Information Exchange, known as PIE, to help obtain timely wage information and reduce payment errors. For people who authorize it and work for participating employers, payroll information can be sent through a payroll data provider. This is not a mysterious camera watching a cash register. It is an information exchange designed to make wage reporting more accurate. But the practical message is simple. Do not assume an unreported paycheck will remain invisible. SSI recipients who work still have reporting duties. Changes in wages, starting or stopping work, taking a second job, or changes in self-employment must be reported. Social Security instructs SSI recipients to report earnings no later than the 10th day of the month after the month of the change. If you earn wages in May, the reporting deadline is generally June 10th. There are reporting options through a personal My Social Security account, a mobile wage reporting application, an automated phone system, and other methods. Keep the confirmation, take a screenshot, save the receipt, write down the date. The system may be increasingly automated, but your protection is still documentation. This is the pattern I want you to see. A favorable rule can increase the payment, but only if the agency has the right facts. An unfavorable fact can reduce the payment, and delayed reporting can create a debt. The same system that may owe someone an extra $132 because a rental rule was applied incorrectly may charge someone thousands because wages were reported late. The mechanism is not personal. It is an equation fed by information. The person who understands what goes into the equation has a better chance of receiving the correct amount. Now we reach the bank account issue, and this is where many retirees become uneasy. Social Security has an access to financial institutions process, often called AFI. It is used to verify bank account balances and identify possible undisclosed accounts during SSI applications and later eligibility reviews. The agency has said the process can conduct geographic searches at up to 10 financial institutions for an individual during a review. It can verify balances in disclosed accounts and look for accounts that were not reported. The 2026 SSI annual report highlighted expanded use of this tool as part of efforts to identify improper payments earlier and prevent large overpayments. Pay close attention to what that means and what it does not mean. It means bank balances matter, and Social Security can use electronic verification rather than relying only on a handwritten statement. It does not mean the Federal Reserve, the IRS, and Social Security are reading every grocery purchase together in real time. Official descriptions of AFI focus on account ownership and balance information for resource verification, not a continuous transaction-by-transaction review of every cup of coffee. I say this because exaggeration creates panic, and panic causes bad decisions. The real rule is serious enough. If you have a checking account, savings account, credit union account, certificate of deposit, or another financial account that counts as a resource, disclose it accurately. If an account is jointly owned, do not assume only half automatically counts. Joint account rules can depend on who owns the money and whether the other owner can prove contributions. Get professional help when ownership is disputed. The first day of the month deserves special attention. SSI generally measures resources at the beginning of the month. Picture a checking account that has $1,700 on the evening of January 31st. A $900 pension deposit arrives early because of a weekend, and the balance becomes $2,600 before February begins. The person sees the deposit as February income. Social Security may need to determine which month the payment belongs to and whether an exclusion applies. Do not guess. Do not move the money to a relative's account to make the balance look smaller. Keep the payment notice and bank record and ask how the early payment is treated. Calendar shifts can make a balance look dangerous even when the deposit belongs to the next month. The right response is documentation, not concealment. Now picture a different situation. A 70-year-old man has $1,850 in checking and $600 in a savings account he rarely uses. He reports only the checking account because the savings account was opened years ago for emergencies. His total countable bank money is $2,450. If no exclusion applies, he may be over the individual resource limit. The fact that he forgot the account does not erase it. The fact that the money is for a future dental bill does not automatically exclude it. If AFI finds the savings account during a redetermination, Social Security can review the months in which his resources exceeded the limit. That can lead to an overpayment. This is how a small forgotten account becomes a large problem. But now reverse the facts. A woman has $2,700 in checking because she received a $1,500 federal tax refund 3 months earlier. Federal tax refunds are generally excluded from SSI resources for 12 months. If the remaining balance can be traced to the refund and she is still inside the exclusion period, she may not be over the resource limit even though the bank balance is above $2,000. If she assumes the account automatically disqualifies her, she may stop pursuing benefits that she can legally receive. If a representative assumes the entire balance counts and the woman cannot show the source, the payment can be wrong. This is why records matter. Save the tax return, refund notice, deposit record, and monthly statements showing what happened to the money. The same principle applies to retroactive benefits. A past due SSI or Social Security payment is generally excluded as a resource for up to 9 months after receipt. Imagine a disabled worker receiving an $8,000 back payment. The money is far above the $2,000 limit, but it does not necessarily end SSI the next month. There is a temporary exclusion. The person needs to keep the back payment identifiable, understand when the 9-month period begins and ends, and plan lawfully before the exclusion expires. Mixing the money with gifts, wages, and other deposits can make tracking harder. Spending it on exempt resources or necessary expenses may be reasonable, but every case is different. Giving it away can create a transfer problem. Buying something merely to hide value can create another problem. This content is educational and does not replace personal financial, legal, tax, or benefits advice. A transfer for less than fair value can cause SSI ineligibility for up to 36 months. This rule catches people who act from fear. A father has $6,000 in a savings account and believes he must get below $2,000 immediately. He gives $4,500 to his adult son. He thinks the account is now safe. Social Security may view the gift as a transfer of a resource for less than fair market value. Instead of solving the problem, he may create a period of ineligibility. The better approach is to learn which resources count, which resources are excluded, whether money can be spent on the person's own legitimate needs, and whether a properly structured trust, ABLE account, burial arrangement, or other lawful planning tool is appropriate. Nobody should create a trust or move assets based only on a video. Trust rules are technical, and many trusts funded with the person's own assets can still count as resources. Retirement accounts are another trap. People hear the words 401k, traditional IRA, or Roth IRA and think the account is untouchable retirement money. For SSI, the question may be whether the person has the legal ability to withdraw a lump sum. If money is available for withdrawal, it may count as a resource even if taking it out would create tax, penalties, or poor long-term planning. If the person is eligible for periodic retirement payments, SSI may require the person to apply for other benefits. The system generally expects an applicant to pursue other money legally available before relying on SSI. A 72-year-old with a $40,000 IRA may be financially worried, but the existence of that available retirement fund can prevent SSI eligibility. A Roth account can be tax-free under IRS rules and still count under SSI resource rules. Again, tax treatment and benefit treatment are separate. Inheritance creates the same collision. Suppose an SSI recipient inherits $12,000 from a sister. The inheritance may not be federal taxable income to the recipient in the ordinary sense, but it can count as income for SSI in the month received and as a resource in later months if retained. If the inheritance includes a second property, that property may count unless an exclusion or conditional benefit rule applies. If the inheritance is placed into a trust, the trust terms and the source of the assets matter. A family that assumes inheritance is tax-free can accidentally lose SSI and Medicaid eligibility. The most expensive mistakes often begin with a correct sentence used in the wrong system. Now tell me in the comments, before hearing this explanation, did you believe the $994 SSI amount was automatic? Or did you already know that housing, income, and resources could change the payment? A simple answer may help another person realize that this confusion is common and that asking for a review is nothing to be ashamed of. Marriage is the next major calculation. The 2026 federal maximum for an eligible couple is $1,491, not $1,988. Two individual maximums would total $1,988, but the couple rate is $497 lower. That surprises people. The rule assumes that two people living together share certain household expenses. Whether that assumption feels fair is a separate question. The practical fact is that a legal marriage can change the SSI category, and the income and resources of an ineligible spouse can sometimes be deemed to the eligible spouse. Deeming means Social Security treats part of another person's money as available to the SSI applicant, even if the money is not handed over directly. Consider Maria and Thomas. Maria is 68 and has no work record. Thomas is 70 and receives $2,600 in Social Security retirement. They live together and are legally married. Maria cannot simply compare her own zero income with the $994 individual rate. Social Security can consider Thomas's income under spouse deeming rules. The calculation includes allowances and exclusions, so it is not correct to say every dollar of Thomas's benefit counts against Maria. But his income can reduce or eliminate Maria's SSI. Now change one fact. Thomas moves permanently to a nursing facility, or the couple separates and no longer lives in the same household. Deeming may stop depending on the circumstances and timing. A change in living arrangement can create a new eligibility result. This is not automatic. The change must be reported and documented. The couple resource limit is $3,000, not $4,000. That means marriage can also reduce the total countable resource allowance compared with two unmarried individuals. A couple with $3,400 in countable cash may be over the limit even though each person has less than $2,000. At the same time, the home they live in and one vehicle used for transportation may be excluded. The number on a property tax statement does not decide the case. The number in countable accounts may. This is why older couples should not assume that keeping accounts in separate names automatically protects eligibility. Spouse deeming can reach resources owned by the ineligible spouse. The higher payment can also come from a state supplement. Some states add money to the federal SSI payment. The amount can depend on where the person lives, whether the person lives alone, with others, in a care setting, or under another state category. In some places, Social Security administers the supplement and combines it with the federal payment. In other places, the state handles the supplement separately. Most states provide some form of supplement, but not every state does, and the amounts vary. A person moving from one state to another can see the total payment change even if the federal rate remains $19.94. A person who never completed a separate state process can miss money. A person who assumes every deposit from the state is SSI can fail to understand which agency must be contacted when the amount changes. Suppose Helen lives in a state that adds $120 for her living category. Her federal SSI is $714 after counting a $300 Social Security benefit and applying the $20 exclusion. Her total could become $834 if she qualifies for the full $120 state supplement. Now, suppose she moves into her daughter's home in another state that offers no supplement and her daughter pays all shelter costs. Helen could lose the $120 state addition and face a federal shelter reduction. The total change could be hundreds of dollars, even though her Social Security check did not change. This is why changing an address is not merely a mailing issue for SSI. It can change state jurisdiction, living arrangement, shelter support, and payment amount. As of August 5, 2026, Social Security announced an enhanced call routing process for SSI recipients who need to change their address. Calls to the national number for address changes are now routed to specially trained representatives who can often complete the request on the first call. Social Security said that since the process began in early June, it had answered nearly 50,000 such calls, with most answered quickly. That service improvement matters, but it does not remove your responsibility. When you move, report the address and explain the new living arrangement, who pays rent, who pays utilities, and whether the household members changed. A mailing address alone may not tell the representative enough to calculate SSI correctly. The agency generally conducts SSI redeterminations for most recipients once every 1 to 6 years. A redetermination is a review of the non-medical rules, income, resources, living arrangement, marriage, and other eligibility facts. It is not necessarily an accusation. It is a scheduled check to see whether the amount remains correct. But the review can reach back through bank statements, wage information, household changes, and other records. A person who keeps a simple monthly folder is far safer than a person who tries to remember 5 years of changes during a phone interview. Here is a practical picture. Each month, keep the bank statement, pay stubs, rent receipt, utility contributions, proof of any large deposit, and the confirmation for changes reported to Social Security. If a relative pays a bill, write down which bill and why. If money is a loan, use a real written loan agreement created at the time, with an obligation to repay. Do not call a gift a loan after a review begins. If you sell a vehicle, keep the bill of sale and deposit record. If an account is closed, keep the closing statement. If a spouse dies, keep the death certificate and report the change. If a pension starts or stops, save the notice. The goal is not to live in fear of paperwork. The goal is to prevent a human memory from becoming the only evidence against an automated record. The banking system creates another confusion through direct deposit. SSI is usually deposited on the first day of the month. If the first is a weekend or federal holiday, the deposit arrives on the previous business day. That can produce 2 SSI deposits in 1 calendar month. It does not mean a bonus was paid. For example, a payment due September 1st can arrive at the end of August if September 1st falls on a weekend or holiday. A person who spends both deposits as August money can face a crisis in September. Banks label the deposit date, but the benefit belongs to the payment month shown by Social Security. Budget by benefit month, not by the number of deposits visible on one monthly bank statement. Direct Express users also need to pay attention to current notices. In 2026, the Treasury selected Fifth Third Bank as the new financial agent for the Direct Express program. New enrollments with Fifth Third began in May 2026, while existing cardholders were told that their transition would occur later and that they should continue using their Comerica-issued cards until instructed or until the card expires. This is exactly the kind of real change scammers exploit. A caller may say your card must be replaced immediately, ask for the card number, PIN, or one-time security code, and threaten to freeze your SSI. Do not trust the caller ID. Use the official number on the back of the card or an official Social Security or Treasury source. A legitimate transition does not give a stranger permission to drain your account. Banks and credit unions also watch for suspicious activity under federal banking rules. But a bank fraud alert is not the same as an SSI eligibility decision. A large transfer may trigger a bank question because it differs from normal account behavior. That does not automatically mean the IRS has taxed it or Social Security has disqualified you. But the same transfer may later matter to SSI if it represents income, a gift, sale proceeds, or a resource. Keep the story of the money clear. Where did it come from? Who owns it? Was it a loan, gift, refund, inheritance, or sale? What date was it received? What remained on the first of the next month? The transfer itself is only the visible movement. The legal reason behind it determines the consequence. Credit score is another separate system. Receiving SSI does not automatically damage a credit score. SSI payments are not a loan, but missed credit card payments, collections, high balances, and other credit behavior can affect a score. A retiree may use a credit card to survive while waiting for a benefit decision, then receive SSI and believe the new payment will repair the score. It will not. Credit bureaus track credit accounts, not the moral reason a payment was late. At the same time, SSI resource rules generally look at assets, not available credit. A $5,000 credit card limit is not $5,000 in resources because borrowed money creates a debt. But cash advances and loans can create complicated tracing questions, especially if the money stays in an account. Do not confuse borrowing capacity with owned money. Medicare creates one more layer of confusion because many people look only at the amount that reaches the bank. Medicare Part B premiums are often taken out of a Social Security retirement or disability benefit before the remaining money is deposited. SSI itself is different, and in many states, SSI eligibility is connected to Medicaid, not Medicare. A person can have Medicare, Medicaid, and SSI at the same time, but each program follows its own rules. If a state Medicaid program or Medicare savings program begins paying the Part B premium, the person's Social Security deposit can rise even though the gross Social Security benefit did not change. People sometimes call that a Social Security raise. It may actually be the end of a premium deduction. The reverse can also happen. A premium begins coming out, the bank deposit falls, and the person believes Social Security reduced the retirement benefit. Always compare the gross benefit, deductions, and net deposit separately. This matters for SSI because the amount of another benefit can affect the SSI calculation. Suppose a person's gross Social Security benefit is $500, but only $315 reaches the bank after deductions. SSI does not necessarily use the $315 bank deposit as the starting number. It may use the gross benefit under the program rules, with applicable exclusions. Looking only at net deposits can lead to a false estimate. The same is true for pensions with insurance deductions, union dues, or tax withholding. The amount available in the bank and the amount legally counted by SSI are not always identical. Now we come to overpayments, because the promise of a higher payment is dangerous if it causes someone to ignore the risk of a payment that is too high. An overpayment notice means Social Security believes it paid more than the person should have received. The notice should explain the amount, the period, and the reason. Do not throw it away. Do not immediately agree that every number is correct. Compare the notice with your records. Was the income amount right? Was a bank balance temporarily excluded? Did Social Security count food after the September 30th, 2024 rule change? Did it use the correct shelter contribution? Did it recognize a move, separation, marriage, or death on the right date? Did a state supplement change? A computer can process information quickly and still process incorrect information. If you believe the overpayment decision is wrong, the usual path is to request reconsideration. Form SSA 561 is commonly used to challenge the decision. If you agree that an overpayment occurred but believe you were not at fault and cannot afford repayment, Form SSA 632 is used to request a waiver. If you agree that you owe the money but the proposed withholding would prevent you from paying necessary living expenses, Form SSA 634 can be used to request a lower recovery rate. These are different requests. Saying, "I cannot afford it" is not the same as saying, "the amount is wrong." Saying, "I was not at fault" is not the same as asking for smaller monthly payments. Use the form that matches the problem and keep a copy of everything submitted. For current SSI recipients, Social Security generally withholds 10% of the SSI payment when collecting an overpayment if no different arrangement applies. The agency's public guidance says collection normally waits at least 30 days after the notice, and a timely appeal or waiver request can pause collection while the request is decided. Rules and procedures can change, and individual notices control deadlines, so read the date on the letter. Do not rely on something a neighbor remembers from 5 years ago. The most expensive sentence in benefit law is, "I thought I had more time." If you want to continue receiving careful explanations like this, consider subscribing to the channel and turning on notifications so you do not miss the next update that may affect your retirement income or bank account. Now I want to bring all of this back to the phrase higher payment. There are several honest ways an SSI payment can become higher. The federal rate can rise through the annual cost of living adjustment. Countable income can fall. A person can begin paying a fair share of shelter costs. A rental subsidy rule can be applied correctly. Food support may have been counted under an outdated approach. A state supplement can begin. Spouse deeming can stop after a legitimate household change. A premium deduction from another benefit can change the amount reaching the bank. An incorrect reduction can be appealed. A person who never applied can establish a filing date and qualify. But none of those possibilities means every viewer is owed money. This is the hidden rule behind the entire update. Social Security pays according to the facts in the record, not according to the facts in your kitchen, your wallet, or your memory. If the record says your daughter pays all shelter costs, the system may reduce the payment even if you began paying your share 6 months ago. If the record says you have an old savings account, the system may count it even if the account was closed. If the record does not show a state application, the supplement may not arrive. If the record does not show that you called to apply, months can be lost because SSI generally cannot pay for periods before the effective application date. This is not automatic. You have to claim it, report it, and prove it. Application timing may be the most financially important part for someone who is not receiving SSI. Social Security advises people to apply as soon as possible because SSI generally cannot pay for time before the effective application date. If you call to schedule an appointment and then keep the appointment and complete the application, the date of the call may be used as the filing date. That date can protect money. Imagine Linda, the woman with the $540 Social Security benefit. She waits 8 months because she assumes she is not eligible. If she later qualifies for approximately $474 a month under a simplified example, those 8 lost months could represent nearly $3,800 that SSI will not simply recreate because she did not apply. The exact result depends on eligibility in each month, but the lesson is clear. Most people think they do not qualify. A screening costs less than losing a filing date. Do not delay because you cannot find every document. Make the contact and ask what is needed. Do not delay because a friend was denied. Your income, resources, marriage, state, and housing arrangement may be different. Do not delay because you own a home or a car. The home you live in and one vehicle used for transportation are generally excluded resources. Do not delay because you receive a small retirement check. Concurrent Social Security and SSI is possible. Do not delay because a family member buys groceries. Food itself is no longer included in the in-kind support and maintenance calculation that can reduce SSI. But be honest about shelter help, cash gifts, and every account. The climax is not a secret bonus code. It is the quiet machinery now working behind the benefit. In one part of the system, the annual inflation formula raises the federal maximum. In another, state databases and benefit records identify other income. Payroll information can arrive through an automated exchange. Bank balances can be checked through the Access to Financial Institutions process. Redetermination interviews review living arrangements, resources, and marriage. A change of address can route to a specialist because the address can change more than the envelope destination. An algorithm can flag a balance. A representative can open the case. A notice can be generated. A payment can rise, fall, stop, or become an overpayment debt. The gears turn silently, but they turn based on information. Here is what almost nobody understands. The system is becoming better at finding facts that reduce or stop benefits, but it still depends heavily on you to report facts that may increase your payment. AFI can find an undisclosed savings account. PIE can help identify wages, but neither tool automatically walks into your home and discovers that you started paying $400 toward shelter, that your daughter stopped paying the electric bill, that your spouse moved out permanently, that your landlord is your parent and the nationwide rental subsidy exception may apply, or that your state supplement application was never completed. The protective strategy is to be as organized about favorable changes as the government is becoming about unfavorable ones. Take your latest SSI notice and read the payment calculation. Find the federal amount, the income counted, the shelter reduction, and the state supplement if one appears. Compare it with the facts today. Check every bank and credit union account in your name or jointly held. Identify which money may be temporarily excluded and save proof. Confirm who pays rent, mortgage, electricity, gas, water, and sewer. Confirm whether food was incorrectly treated as support after the rule changed. Review whether a spouse's income is being deemed and whether the household facts remain correct. Check whether a state supplement exists for your category. Report changes promptly and keep confirmation. If the amount appears wrong, request an explanation in writing and use the proper appeal or waiver process. Do not manufacture a rent agreement, hide an account, move money into another person's name, or call a gift a loan after the fact. Those actions can turn confusion into a much more serious problem. The goal is not to beat the system. The goal is to make the system use the correct facts and the correct exclusions. There is a major difference between lawful planning and concealment. Lawful planning uses rules openly. Concealment depends on the hope that nobody will notice. In 2026, that hope is becoming more dangerous because financial and payroll verification tools are expanding. I also want to speak to the comfortable middle-class retiree who thinks none of this applies. You may not qualify for SSI because your income or available retirement resources are too high, but your widowed sister may qualify. Your disabled adult child may qualify. Your spouse may qualify after your death. You may qualify later if income and resources change. The same habits also protect Social Security retirement, Medicare, taxes, and inheritance planning. Keep records. Separate gross benefits from net deposits. Understand what an account is legally owned by. Review beneficiary designations. Do not assume a Roth IRA, 401k, trust, or inheritance has the same treatment under every program. This helps both lower-income retirees and comfortable middle-class retirees because the cost of confusion does not respect social class. The most protected person is the one who can show the date, amount, source, rule, and proof. That person is harder to overpay, underpay, or scam. Calm records are stronger than panic, and a timely application is stronger than months of wondering. You work too long to let a misunderstood shelter rule take $331.33 a month without checking it. You sacrifice too much to let a forgotten $600 savings account create years of overpayment. You paid too many bills to assume the $994 maximum belongs only to someone else. You also deserve the truth that no honest advisor should hide. The higher payment is not guaranteed. SSI is not a universal retirement benefit, and the resource limits exclude many people who still feel financially insecure. Protection begins when hope and caution are used together. Review the record. Ask for the calculation. Apply if the screening suggests possible eligibility. Report favorable and unfavorable changes. Keep proof. Use official Social Security channels. Get professional help when a trust, inheritance, retirement account, joint bank account, appeal, or large overpayment is involved. There is still time to correct many mistakes, prevent new ones, and protect the money that keeps a household stable. Share this video with a parent, spouse, sibling, veteran, widow, or friend who receives a small Social Security check and assumes SSI is impossible. Sharing accurate information can protect someone from losing months of benefits or from receiving money that later becomes a debt. And if you believe this was important, watch the next video appearing on the screen now. In that video, I explain another quiet rule that can change the money millions of older Americans receive and the mistake that can trigger a painful notice when they least expect it.